treat today, this evening. All right. The woman that I'm about to bring forth, I met her some years ago, and she actually came out and spoke at our first annual Wisdom and Wealth Conference. And, I didn't have it was like I didn't have a whole lot of money to give her and a whole bunch of, put her in front of 300, 400 people. But she came and she served. She set up her table in the back. She was out there networking, doing her thing. And, she was just joyful and she was just excited to be able to share the information. And she has been a part of us taking the wisdom and wealth behind the scenes, taking this to a whole nother level. All right. She's been able to help me in some different areas, and an area too that's huge, that's about to be real major. And it's going to allow some real wealth to flow through there. So I'm excited about her. She has an extensive background. She's in the tax, and she's into financial literacy. She has a wealth of knowledge. She loves helping people. She's down to earth. She is in the Louisville, Kentucky area. For those of you that are in Kentucky, Indiana, and some of you is in Ohio, all right. But guess what? She's not limited to just those 2 or 3 states. I connected her to someone in North Carolina. I connected her to someone in somewhere else. So like she can reach you all around the country if you need some help. So at this time, I want you to grab your pens. I'm not telling you to do something I'm not doing. Grab your pads, all right, and be able to get ready to write down these golden nuggets. So I want to turn it over to Toya Traynor. The call is yours. The Zoom meeting is yours at this time.
Hey everybody, how are you? I appreciate you guys being patient with me tonight. I might be not as vibrant as I normally am because tax season is in full effect for your girl right now. But we are going to take a few minutes tonight to kind of break down business taxes. That's the things that I get a lot of questions about. We're going to talk about the different ways that you can be structured, what's kind of some pros, cons of those different ways. And then we'll talk about some things about like what you can write off and all those things. And then we'll have some time, hopefully at the end, that I can answer any questions that anybody has. So let me share my screen. Okay. Can you guys see that okay?
You're good.
Okay. So this is just a little bit about my background. So I have my accounting degree. I've been working in taxes and accounting for 20 plus years. I think I need to update that. It's probably like 25 years. I actually am working on becoming what's called an enrolled agent. So it's the highest destination that the IRS gives. I've passed 2 parts, about to take the last part after tax season, and that will allow me to have full representation rights in front of the IRS. So what that will mean is like go to court, if you have to argue with the IRS that way or negotiate with them on payments and things like that. So that will definitely add to my business and be able to help with that. All right. So the first couple of things that we're going to talk about is, again, how can you be structured as a business? Okay. This first way that we're going to talk about is sole proprietorship. It's kind of like our default. Okay. So even if you don't ever register the business with a name or get an EIN number with the IRS, this is what you are if you're working independently, not getting a W-2, right? Okay. So you could be just selling things to people online, in person, whatever. This is what you're defaulted as, a sole proprietorship. Okay. And so what that means is that it's sole, one owner. Okay. And for tax purposes, the owner and the business are kind of treated as one in the same. Okay. So there's no delineation between you and the business. And that means that it goes on your personal tax return. So there's not like you have to file a separate tax return for the business. You file it with your personal. So if, say, your wife has a W-2, she works a job, and then you have the business, those two things are just going to get added together, and then we're going to figure your tax on it. Okay. And the paper that we add for that is called a Schedule C, profit or loss for business. So that's where we put your income, minus out any expenses you have, and whatever's left. If it's a positive number, it's your profit. If it's negative, it's your loss. Okay. In addition to your regular income tax, though, when you're set up this way, you have to pay what's called self-employment tax. Okay. And that's 15.3%. Now, they didn't just make that number up out of the sky. we've all on here probably worked a W-2 job in our life, right? And so when we get paid, we see Social Security and Medicare come out of our paychecks. Well, that's what the self-employment tax is. It's the employer portion and the employee portion. So when you see it come out of your check, the employer is matching that same amount for everybody that works there. Those two together add up to that 15.3%. Okay. So that's where that comes from. So that's the way that us as self-employed people pay into Social Security and Medicare. You know, whether that should happen and we're ever going to get that money back, that's a whole nother discussion. But we have to pay into that system. So that's what that is. This is what the Schedule C looks like. So if you've ever done any type of self-employment work, you've filed one of these on your tax return, okay? The next way that you could be set up is as a partnership. So obviously, we said the sole is the default, and that's one person, and that goes on your personal. Well, if me and Joseph decided to go in business together, we don't file our personal taxes together, right? So we can't do that on our personal tax return. So we have to set up a separate entity called a partnership. And we'll have a partnership agreement, which is very important if you go in partnership with someone, to make sure you have that in writing, what the stipulations of this partnership are. What's your percentage? What's my percentage? What's going to happen if we want to bring in a new member or if we want someone out? Like all those things will be laid out in that partnership agreement, okay? And so then the partnership has to file its own tax return, and that is called a 1065 partnership return, okay? And this is what we call a flow-through entity. So what that means is that the business itself doesn't pay the tax. It flows from that partnership return down to the partners, okay? So let's put some numbers to this. Again, if me and Joseph were in business together, we're 50-50 partners. If our business, let's say, made $10,000 for the year, and then after we took out all our expenses, we had a $2,000 profit. If we're 50-50, he's going to have to claim 1,000. I'm going to have to claim 1,000. And the paper that we get from the business that shows that is called a K1. Okay, so we would get a K1 from the business showing our share of the profit or our share of the loss. Okay, and then that's what we report on our personal taxes, and that's where we pay the tax. So the only step that's different from what we talked about before is that you have to do the partnership return first. Those are always due March 15th. So I was crazy a couple weeks ago trying to get as many of those in as we could. So those are due March 15th to give us time to get our K1s so that we can file our personals by April 15th. So if you don't have your stuff together by March 15th, and you have to file an extension, you have to automatically file an extension on your personal. You can't just say, oh, well, I'll do the business later and I'm going to go ahead and file my personal taxes. No, because you're missing that form. So you have to wait. So if you do a partner extension here, you have to do an extension there. Okay. Tax-wise, though, it's exactly the same as what we just spoke about. Whatever's on that K1, you're going to get taxed at 15.3%. Just like you would if you were a single member or a sole proprietorship, okay? This is what the partnership return looks like. The next way, and probably the one that everybody hears the most, that people are on the TikTok videos and the YouTube videos talking about all the time, is the S corporation, okay? So an S corporation is actually not a tax structure. It's an election that you make. So you could be the sole proprietorship, you could be a partnership, and you tell the IRS, I know this is what I am, but I would like to be taxed this way, okay? And the form you use to do that is Form 2553. So if you want to elect to be an S Corp, that's the form you file with the IRS to tell them that's what you want to do, okay? Other than that, it's very similar to the partnership in that this is also a flow-through entity. So again, the business is not paying the tax. It is flowing down to us. But instead of calling us partners, we're going to call us shareholders of the business, okay? That's the difference. Also due March 15th, also going to get the K1. And for an S Corp, it can have one shareholder all the way up to 100. Okay. So you could be a sole single, like my business now, I just elected this year to be an S corporation for 2025. So my business, I'm the one that gets the K1 only for whatever the profit or whatever the loss is from that business. And that's what I put on my personal tax. The reason why you hear on the TikToks and on the YouTube and everybody say be a S corp, be a S corp, be a S corp, is because when you're an S corp, that 15.3% self-employment tax that we just talked about, that goes away. You don't pay it. Okay. The part they leave out, though, on the videos and the TikToks is that the reason why you don't have to pay that is because you're supposed to pay yourself a reasonable salary and put yourself on payroll. So you're paying in the Social Security and Medicare on a W-2. So let's use me as an example. My business is called Truth Tax. So then I have to have a salary coming to me from Truth Tax. And at the end of the year, I am going to get a W-2 showing what Truth Tax has paid Toya Traynor for the year. Okay. In addition to, I'm going to also get my K1 from Truth Tax for whatever my profit is. The advantage, though, is if I say my business made 100, I'm going to put myself on payroll for 50. Now my business only made 50 because I get to subtract that salary as a business deduction. I also get to subtract my half as the employer of the payroll taxes, right? And then there's all kinds of tax things that we can do there. Like a lot of my S corp people, I have them on payroll, but then we can set them up with like a SEP, IRA, or a solo 401k plan so that they are also putting money aside, which then is a deduction to them and lowering the amount of taxes that they have to pay. So there's all kinds of things we can do there. But I like to always let people know, me personally, I don't just always throw everyone to a S corp just because that self-employment tax is gone. You have to be making enough money for this to even make sense, right? I hate to always say exact dollar amount because it varies, but ideally you want to be around 60, 70 profit before this should even be a conversation. Okay. Because again, you have to put yourself on payroll. You have to pay the payroll taxes. These type of returns cost way more for preparation. Then who are you paying to do the payroll? You got to have ADP, Gusto, what? Those things can start adding up. If you're not even making any money right now or not making that type of money, why put yourself in that hole, right? The other thing is, I don't know if you all have heard the word commingling. That's where you mix in your business and your personal things together, right? They're all jumbled in one pot. We really shouldn't be doing that as a business, period. But when you're a sole proprietorship, it's not as big of a deal if you're mixing stuff. You know, we're seeing your haircuts and going out and the movies and your mortgage coming out of the business bank account. Not so big of a deal when you're that way. But when you're set up as this corporation, the corporation is set up as a separate entity from you. We can't be mixing and mingling stuff. So a lot of times with my clients, we kind of work our way here because when people first start businesses, there is a lot of that mix. It just is. And so we like to see you get that cleaned up before we get over. The other thing is for me that you have to pay your payroll taxes timely. The IRS don't play about payroll taxes. That's one of the biggest things that get you in trouble. So if I tell you, say you're just a sole proprietorship, and I say, okay, Joseph, this year I want you to set aside 10% to taxes. Okay, I want you to put that aside. And when I see you next year, that's going to be what we're going to use to pay your taxes for your business. And then you come in next year and I say, okay, Joseph, how much money have you set aside? Well, what had happened was, and this came up and I couldn't do it, Toya. Well, if you can't do that, how am I going to know you're going to pay these payroll taxes on time? Right? So again, we want to step our way to doing the things. We want to first start knowing how to make our estimated tax payments regularly. Right? Once we can do that, we're on top of it. We're not mixing our stuff and we're making good money. Then for me, that's when we have these types of conversations. Okay. This is what the S Corp return looks like. The last way that you could be structured, other than nonprofits, which we're not going to talk about on this presentation, but a C corporation. So think like Target or Walmart, right? Those are all C corporations. The C corporation is completely separate from you. So there is no flow through. There is no you paying the taxes. The business pays the taxes, and it's a flat tax rate, 21%. Okay. And the only way you take money from that business is if you put yourself on, you have to be on payroll. And then at the end of the year, if the business makes a profit, you can pay yourself a dividend. Okay. Some people like this because it's flat. They know exactly what the tax is going to be. They don't have to think about it, whatever. But you can't really just be drawing money. So ideally, I always tell my clients, what's the objective with the business, right? If this business is my sole bread and butter, like for me, I don't have any other job, whatever, this is how I live. So I need to pull from my business. So for me, the S corporation works because if I need to take a draw, I can take a draw, right? The C corporation think I already have a job over here, or I have my other business that I live off of. This is really more of an investment for me, right? And so everything that this business is making, I am going to turn around and reinvest right into the business. I don't necessarily need to be pulling from that. That's when the C corporation would make sense. Okay. Now, again, everybody has a different rule of thumb about that. That's just kind of how I explain it to my clients. And this is what the C corporation looks like. The last way that we talk about is an LLC. And you notice we were talking about all these tax structures and I never mentioned LLC. And that is because the LLC doesn't have anything to do with how you're taxed. That is one thing that people confuse a lot. I'll get a new business consult and I'll say, well, how are you set up? And they say, I'm an LLC. That doesn't tell me. Because the LLC is just a legal protection that puts a buffer between you and the business so that if someone were to sue you, they can only come after the things in the business name, not your personal house, personal car, things like that. Okay. And so you could be an LLC and be all those ways we just talked about. Sole proprietorship, S Corp, partnership, C Corp. You could be an LLC. Okay. All states are different on their rules and how friendly they are with the LLCs. In Kentucky, we have a 175 minimum. So if you have an LLC in Kentucky, whether that made no money or whether you made $1 million, you have to pay them $175 every year to keep yourself in good standing. Okay. Indiana, it's $50 every 2 years. And if there's somebody on here that like is in a different state and you're unsure, I'll give my number and everything after this. You can always ask me what your rules are for your state. But every state has different things to be compliant. Okay. And then these couple slides talk about sales tax. This is more based upon our Kentucky folks. Here in Kentucky, they decided that they wanted to start adding sales tax to a lot of service-based businesses. So we all know what sales tax is. It's when you buy something, right? We go to the store, we get this cute little shirt. They're going to add the sales tax to that, and that's what we're going to pay the person, right? Well, when you're a business and you're selling tangible items, you then are supposed to be charging the sales tax to the customers and collecting it, okay? And then you hold on to it, and then you give it to the state based upon when they tell you, whether it's monthly, quarterly, annually. You're supposed to be the middleman, right? You're not supposed to be paying that out of your own pocket. And I see that sometimes because they don't know, oh, I'm supposed to add this, or oh, if I add the sales tax, then maybe they won't want to do business with me because that's a higher price. The customer's supposed to pay that. They don't go to Target and negotiate that they don't want to have to pay sales tax. So why should they negotiate with you? Like it is what it is. It's the law. So add your sales tax on the invoices. I suggest for my clients to set up at minimum 2 business bank accounts. So you have one for your business, like the money coming in, your expenses coming out, everything. Another one for taxes. So then you can get in the habit of when somebody pays that invoice, and in Kentucky, our sales tax is 6%. So you take that 6%, move it on over to that tax account. That way it's out of sight, out of mind, because you might not have to pay them, but quarterly, which is every 3 months. Well, what happens is if you don't move that out of your bucket of money to spend, you think that that's your money. And then when I call and say, okay, your sales tax is due, it's $1,200. And you're like, I don't have $1,200. Well, now you're having to come out your pocket to pay that $1,200, right? Versus if you just go ahead and move that out of the way, out of sight, out of mind. Now, if you're somebody who has a lot of transactions coming in, like your retail or something, There's services that you can have that do it automatically for you. Like if you have like a Shopify site or a restaurant, a lot of my restaurant clients, there's a service called Davo, Davo, and that will take it out as it's coming in. So as the money's coming in, just like how the companies take out their credit card processing fees, they will take out the sales tax and remit it for you. So then you don't even have to think about it. But if you're one that, you might sell something here, sell something there, or whatever, just try to go ahead and get in the habit of doing it. But here in Kentucky, they said, now we're going to start adding sales tax to services as well. And there's a lot of services that I meet that don't know they're supposed to be charging sales tax. So these are just some of them, but massage therapists, photographers, if you're a personal trainer. This one's a big one, event space rentals. So like I have a lot of people, that's like one of the new things that came out through COVID is everybody want to open an event space, right? So I have an event space that I rent out to people for weddings and whatever. You're supposed to be charging sales tax. Same as if you rent out equipment. So like I have a girl who she rents out the chairs and the tables and the things like that for weddings and stuff. Same thing. You're supposed to be charging sales tax. Cleaning businesses, you're supposed to be charging sales tax, whether it's residential or commercial. Tattoo artists is another. Lawn care. Admission. So like if you're somebody who's throwing events or parties, you're supposed to be charging sales tax for the tickets for those. So those are just some of them. But those all are supposed to be charging sales tax and then turning it into the state. Some other taxes to be aware of is your local occupational taxes. So like here, I'm in Louisville, Kentucky. Just like when you work a W-2 job and you see the local taxes come out of your paycheck. So some places like Ohio, they have school districts. Here it's our local localities, what city you're in. But either way, you also have to pay that same taxes to those places if you operate a business in their areas. Okay. And whoever files your taxes, if you're going to someone, should be doing these things for you, or at least letting you know how to go out and file. Okay. The other things to be aware of is your annual report. So like once you register your business name with the Secretary of State in your area, usually there's a fee or an annual report each year to keep compliant with that. So here in Kentucky, it's $15. They just started sending those emails out. So everybody's getting emails saying, hey, it's time to do your annual report. Click that email, go out there and pay the $15. I will say, I posted on my Facebook last week, a lot of people, there's always scammers in everything that goes on. So people are getting letters in the mails because they know it's time to do the annual report, but these are companies who are adding on a fee to go file it for you. The annual report is $15 only. These letters were saying 175 and 225 and all this stuff. Do not pay that. And if you're ever unsure, please text me or ask somebody, but don't just think, oh, I have a business and they have my business name on there, so I should pay that. No, don't do it because it's a scam. It happens because anything you file with the government or your locality, the city, as public record. So people can get a hold of that. Like me, I just registered my business. I'm trying to trademark my logo and I filed that online. And then I started getting all these emails telling me I didn't click something and I need to pay this. Thankfully, I called them and they were like, no, those are all scams. Ignore all that. We don't communicate with you that way. So just make sure you always check before you go pay some scary letter. The other thing is monthly or quarterly payroll filing. So again, if we set you up as an S corp or you have employees and you want to always make sure you're paying the payroll taxes. Okay, it's best to get with a payroll service that will do all that stuff for you. So as you're running the payroll each week, the taxes are coming out right along with it, so you're not getting behind on those things. Last few slides talk about what can you write off. Okay, that's one of the questions I get all the time. Can I write this off? Can I write that off? I always say, as long as it's related to your business, we can find somewhere to put it. Okay. When we were looking at those forms, it had all the categories, advertising, this, that. But there's a whole nother line that says other. And so we can put things that don't necessarily fit into a category. What the tax code says is that you can write off things that are ordinary or necessary for your type of business. Okay. So that's going to vary depending on what type of industry that we're in, right? So if I am a business that's a nurse, right? I'm going out. Now, this is not W-2. W-2, you can't write off expenses anymore. That changed. But if you are a business and say you're a contractor nurse, you go out and you do this consulting or whatever, and you're wanting to write off scrubs or medical equipment, that would be ordinary or necessary for that type of work. But me as an accountant, if I try to write off scrubs, well, that's not ordinary or necessary for me, right? It doesn't make sense. For most of us, grooming and things like that are not ordinary. And that, like, yes, I want to be clean and cute when I come to work, but I can wear those clothes elsewhere. It's not specific to my job, right? But a lot of the people now who are doing this social media stuff, like the content creators and things, I can let them write off a lot of stuff because their nails got to be a certain way. Their this got to be because that is their business. Their image is what they are. So it just really depends upon your industry. And if you're unsure, like ask. But these that I'm going to go over are just some general deductions that pretty much most of us use, right? So advertising. One thing to note on that is now in the age of social media, that's your boosting your post. If you're paying to boost a post or to do an ad on Facebook or Instagram or whatever, that's deductible as advertising. Okay, you can do that. Contract labor. So this is a new thing that changed with this one big, beautiful or ugly bill, whatever you want to call it. So this changed. So it used to be if you were paying someone to work for you as an independent contractor, like you're paying somebody to do some work for you, but they're not an employee of yours, okay? You were supposed to give them a 1099 if you paid them more than $600 throughout the year. That's how the rules always been. But now it's changed. So for 2026, it's 2,000. So you only have to give somebody the 1099 if you paid them more than 2,000. And then the same for you in reverse. If you're a business and you're doing contract work, they're not going to give you the 1099 if you didn't make more than $2,000. Okay? My rule of thumb with my clients is, and I have blank ones, so if everybody needs one, you can Google it or whatever. You need, before you ever pay somebody, you need to get them to fill out a W-9. It's the form. It's called a W-9. And what that W-9 does is when the person fills it out, they're giving you their name or their business name, their address, and their either social or EIN number. And you hold on to that. So that at the end of the year, come January, when Toya's calling and saying, okay, do you need to cut any 1099s to people that you paid? Yeah, but I ain't been able to get a hold of her. She ain't answering the phone, and I think she done moved to here. Mm-mm. Before you pay them, give them the W-9. That way, if they ran away, it don't matter. We can still cut that 1099 for you so that you as the business owner can write that off. So just start getting in the habit of that. You want to get paid from me? Cool. Then you need to fill out this W-9 and then I will write you the check or Venmo you or whatever we're going to do. Okay. So just try to get in the habit of doing that on the front end. That way you're not chasing people down at the end of the year. Okay. Because if you're paying people and it's more than the 2,000, I can't put that on your taxes as contract labor if you didn't 1099. You didn't do what you're supposed to do. So we want to do that on the front end. Insurance. So that could be any types of insurance. Your professional insurance, like I have to have errors and emissions insurance and all these types of insurance. Any of that you can write off. Legal and professional. So again, whatever you pay your accountant, pay a lawyer, whatever, set up your business, any types of professional fees. If you take a course or, anything like that. Rent or lease. Now, we will talk about home office. This is not necessarily home office. This is like me, like I'm in an office space. So what I pay for my office space is what we're talking about here. Or if you rent a vehicle, like a lot of guys that do like trucking or doing deliveries for Amazon and stuff, you might rent a van and then you're paying the rent for that van. That would be what we're talking about. Okay. Or renting a backhoe if you do construction. Repairs and maintenance. So again, that would be on your office space or on your equipment. Meals, you get 50%. Okay. Technically, the meals are supposed to be business related. Okay. It's supposed to be business related. I am not going to get on this call and tell you that we don't write off meals that are not business related. Okay. If I go to a nice restaurant, I'm writing down who I'm at dinner with on my receipt, but most of my friends are clients. So there you have it. It's just a business, it's a business meal. So that's what it is. But like your lunch, things like that, no. Like if you're just going to McDonald's, grabbing something, or you're going here, no. But like you're supposed to have a business discussion or be meeting with a potential client, things like that to write off the meals. Taxes and license. So like I was saying, Kentucky, that 175, that's deductible. Any types of licensing or taxes that you have to pay is deductible. Home office deductions. So if you work from home or you use home as a storage space, so it might be your garage or whatever, we take whatever the square footage of the space you work out of and the square footage of your whole house, divide those, and whatever that percentage is, then you can have a percentage of your rent or mortgage interest, your property taxes, your utilities, all of those things for your house, your insurance, repairs, all of that stuff. And you can take that as a home office deduction. Okay. It's supposed to be a dedicated office space, though. It can't just be like, oh, I sit on my bed with my laptop and do my business stuff. Well, it needs to be like an actual little, even if it's just a corner of the room, but like you use that as your workspace. Okay. Last thing, vehicle expenses. This is a big one that we always get questions about. What about my vehicles? So there's two ways to do vehicle expenses, okay? So the first way, the easiest way is standard mileage. So that's where every year they give us what the standard mileage rate is. You multiply that by every time you go, every mile you drive, and then that's the deduction. Okay. For 2025, the tax year we're filing right now, it was 70 cents. Okay. If it, or you can do actual. Okay. So what actual says is like whatever the value of that vehicle is, and this is whether the vehicle's paid off or not. Okay. Whatever the value of that vehicle is, we're going to divide that by 5 because vehicles depreciate for 5 years. And we're going to divide that, and each year you get to take a chunk of that, and that's called depreciation. Okay. Now there's some more technical stuff where we can take chunks up front, and if the vehicle's more than 6,000 pounds, you can take more and all those types of things. But that's the basic premise of it. Okay. You take the value plus any gas, oil, insurance, all those types of things. Okay. But if it is not 100% work vehicle, then you still have to track mileage either way, because that's how I know how much gas, how much oil, all that stuff to allow you to have. Okay. You do not have to do any fancy apps or anything to track miles. You could literally have a notebook that you keep in your dashboard and you write it down and throw it in there. Write it down, throw it in there. Some people don't even track miles, they track where they go. So like if they go to the same places a lot, they just write down, I went to this place 10 times, I went to this place 20 times, and we know how many miles it is from there to there, and then we do the math at the end of the year. Whatever's easier for you, okay? But you do want to track it. So we're still early in the year now. We're in March. If you haven't been tracking it, write down where you're at right now. So then we know, then you get in December, write down where you're at. You at least know what you drove the whole year, right? Try to start getting in the habit of doing that. Oil change receipts are a good way to find that too. So if you go somewhere and get your oil change, you know, they get your mileage wrote down. You find one in January, find one toward the end of the year, you kind of, at least you know your total miles. Then we just have to figure out how much of that was business. Okay. It's not supposed to be commuting. So it's not supposed to be, for instance, y'all might not know these areas, but I'm in Louisville. I'm originally from Bardstown. So when I first started my business, I lived in Bardstown, which is like 35 miles from here, but I chose to start my business up here. That's technically a choice. So I'm not supposed to count driving from home to work, right? But if I then come to work and then I go to the bank, or I go to meet with a client, or I go to do whatever, all that mileage would be deducted. Okay. So if you traveling, like say you're a hairdresser and you're going to Atlanta for a hair show, if you flew there, you drove there, that's all deducted. Okay. So last couple slides, just I think this is the last slide. It just talks about the one big beautiful bill and different things that changed this year in relation to that for taxes, because there was a lot of changes that were made. So I'll start with the business side since that's what we've been talking about. Then I'll talk about the individual. So on the business side, he brought back 100% bonus depreciation. So that means if we bought something that's qualified, instead of having to spread that car across 5 years, we might be able to take all of it up front this year. Okay. That was supposed to expire, but they went ahead and extended it. The 1099Ks are only required to report 20K or 200 transactions. So that's when you're taking credit cards. Like if you have a business and you're taking credit cards, whether that's Stripe, Toast, Shopify, like we talked about, any of those. Before they were, remember everybody was talking about there for a couple years that like Cash App was getting ready to start giving everybody 1099s if you were transferring money to people and paying people, and everybody was freaking out about it. Well, they took that away and said, no, we're just going to keep it at what it was. If you made 20,000 on those card transactions or 200 transactions, that's when you get the thing. Regardless to whether you get it, though, technically by law, any money you make is supposed to go on that tax return. Okay. What I tell my people is if you don't want me to put that on the tax return, then it don't need to hit the bank account. Because if it goes in the bank, I got to count. Do with that information what you want. But that's what I do. So if it goes in the bank, it's got to go on the tax return. Okay. 1099 again went from 600 to 2,000. And then QBI, qualified business income deduction, is a deduction there for businesses. So when you have a business, you can take up to 20% of your profit as a deduction. They kind of raise those limits for that. So that was one of the things. On the individual side, there's a new deduction. This is supposed to say 6,000. Sorry. It's supposed to say 6,000, sorry, per person. So our senior citizens, we all, some of them, if they're getting Social Security. So if there's any people on here that get Social Security, if you're getting Social Security only, that's not taxable. Like that's their only income. You don't even have to come see me. You don't have to file taxes. But if you are still working while pulling your Social Security, or you're getting a retirement, or maybe your spouse works, then that could make your Social Security taxable, and then you have to file it, right? And so what he's trying to do is try to help with that a little bit. So seniors are getting an extra deduction, 6,000 each person that's over 65 on the return. So if both husband and wife are over 65, they get to subtract off an extra $12,000. Okay, so that's one thing that changed. The child tax credit went from $2,000 to $2,200. So again, child tax credit is for your dependents that you can claim as a dependent, and it's up until they're 17 years old. So if they turned 17 in 2025, you don't get the child tax credit anymore. So it's up until they turn 17. So now that's $2,200 per kid. Okay. The daycare credit. This was a big one. A lot of people don't even get to use it really, but you used to get like he's increased the amounts that you can possibly claim for that. It's still a 600 max credit, but income levels of who can claim it and not be phased out went increased. These last three are the ones that everybody's talking about on social media is like the big thing, the SALT cap. So I don't know if we're all familiar with like when we file our taxes, we can either, after we add up all our incomes, we can either subtract out our standard deductions or we take the itemized deductions. Okay. The standard's the number they just give us. Okay. And then itemized is like things like mortgage interest, property taxes, donations to charity or church or whatever. All those things add up. Whichever number is bigger is the one that we take. The standards have been so large with the new tax changes that most people haven't been able to itemize anymore, even if they did donate or even if, so if you go to your tax person, they'll probably say, oh, you don't even got to give me all that stuff no more because we're not even going to use it, right? Well, what he did, there was a $10,000 cap on the tax portion of the itemized. That went away. So this year, there's no cap on your tax part you paid in. So I've been seeing people be able to actually itemize this year and take a larger deduction. The other thing is no tax on overtime. So if you work overtime at your job and it's not the full overtime amount, it's the half portion. So we know when we work overtime, you get paid time and a half, right? So it's the half part that you're able to deduct. So if you're looking at your last pay stub of the year and you look at the total amount of earnings for overtime, if you divide that by 3, that'll give you the number you get to subtract off from your income. Some employers are putting it on the W-2 in box 14. So if you see it in box 14, it'll say overtime. That's the amount that you use to write off. But they're not required to give you that number this year. So if they don't give it to you, just pull your last pay stub, divide that number by 3, and that's what you can use. Okay. And then the very last one is that you can deduct personal car loan interest. It used to be we can only deduct interest if we were a business on our car. But there's very strict stipulations on this. The loan for the car or the purchase of the car had to be in 2025. It has to basically be a 2025 vehicle because you have to be the first person to drive this vehicle, right? And it had to be manufactured in the US. So those are the requirements. And on the IRS's website, there's like a little VIN check where you can put your VIN number in to check and see if your car qualifies. And then if so, you can write off any interest you paid in 25. And then this last slide just says what all I do. So bookkeeping, payroll, teaching, this is what I love to do. So just consultations, teaching, setting up software. Like if you have QuickBooks or FreshBooks and you don't know how to use it, we could do a month of that together and I can show you how to use it. Setting up businesses, just pretty much I try to be flexible. And then we do all taxes. So whether it's your individual taxes, S corps, partnerships, C corps, whatever, we can take care of all of that.